Look at that. All right. And look, I'm the only one here. Oh, and it's me. Oh, Jason, you there? All right. Jason, you're on mute. I'm actually signed in under Shane because Shane's having problems getting in. But you're on mute. Maybe I need to unmute you. I don't know. Oh, that's muting me.
How about now? Can you hear me now?
Oh yeah, now I can.
Perfect. How can do you guys? My video is.
Your video is not working, but now I got to figure out how. Like Shane can't even get in here. Hold on a second. Oh, Jesus.
I was having trouble earlier getting in.
Yeah,
I
I
tried
had
to
to
get in
sign under
30
his
minutes.
name.
Okay.
Advanced sharing options. I'm just gonna say,
How about the video? Can you see me now?
hold on. No.
Well, you might not be able to see me, but are you able to give me access?
Yeah, you can, yeah, you should be able to share your screen. At the bottom of the screen, it says share screen.
Yeah.
You see it? Oh, gosh, it's calling me. Same person.
The participants, share, reaction, leave.
It should be at the bottom, like participants, polls, does it say share screen?
I'm sorry. Yeah, it does right here.
Okay.
There's a couple things that I want to share with everybody, but the
Okay.
first thing will be this one.
Okay.
Can you see this?
Yep, and we can see it. We'll give it a few.
Perfect.
Okay.
Yeah, you might not be able, I don't have a video up, but that's okay. As long
That's
as you
all
can
right.
see as long as you can see what I'm going to show you guys today. That would be great.
Yeah.
Let me see how to get out of this. How do you no longer share it?
You just hit the button again, say stop sharing.
Oh,
The button again that you pressed. There you go.
perfect. Excellent. Pretty easy stuff.
Yeah.
All right. That sounds great. We'll wait for a few minutes. It's just now.
We'll wait for a few minutes. How are you doing today?
Doing good. How about yourself?
Good, 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 good.
How's the weather?
Oh,
up
there you are, Shane.
Yes, I'm having some computer troubles. Isn't that craziness? So I'm on my phone, but
Yeah. Well, I'm glad you gave me your Zoom login.
Let me try that. Maybe I'm able to get in from. Hi, Shane. My name's Jason Wade. Very nice to meet you.
pleasure, Jason.
I'm going to try to see if I can get in from my phone. For some reason on my desktop, the video is not allowing me to share it with you guys or see me. So let me check another source of internet and see if I can get on my cell phone, and I'll do it that way.
Yeah. Isn't technology wonderful?
I have 3 of them sitting right here, different, a laptop, a phone, and then of course the desktop. So we'll see if one of them will work.
Well, thank you, Cindy, for being the anchor here and pulling us all together. I appreciate that.
No problem. Anything for you.
How's the weather in Arizona?
It's quite nice. Actually, I'm gonna go meet Colleen
Oh,
for
nice.
a drink after this because it's 4 o'clock here. So as I was texting her multiple times today for what reasons,
Yeah.
I said I might need a drink. Would you like to meet up? She said, sure. So
Well,
we're gonna go to what's that?
Tell Colleen I said hi.
I will. We're gonna go to Modern Margarita, and I'm gonna try to lock her in still for another comping or something session, some kind of session.
Yeah.
I'll try to get her.
She's a powerhouse.
Yeah. So, yeah. So we're gonna go have a drink and a appetizer or something. I don't know.
Well, margarita sounds pretty good.
Margarita does sound good to me. I mean, I think it's like 70 degrees here.
Oh, nice.
Yeah, very nice.
40 here today, but it's raining.
Yeah,
And
we
I think
actually, we got a thunderstorm last night here. Yeah, which is, we go into a dry spell from like, I want to say from like now to like June, and then we get monsoon season. We won't get any rain. At least that's notorious. But we will see.
it comes in cycles.
Cycles, yes, cycles. Yeah. That's it.
So Cindy, my phone's taking a minute
Okay,
to
well,
upload it.
don't worry, Jason.
Why it's downloading it, I will, you guys usually wait a couple more minutes to get started with us?
We can start, and it's being recorded, so we'll
Oh,
post it.
okay. Perfect. Well, that sounds great. Well, Cindy, you want to start the meeting and introduce me?
Yeah,
Or
go
would you-
ahead. Yeah, no, go ahead, introduce yourself and your
Okay, sounds
background,
good.
and we'll go from there.
Perfect. Cindy, thank you for giving me the pleasure to talk to your group today. My name's Jason Wade. I'm out of Tucson, Arizona. I'm in the financial service business, so anywhere from doing insurance policies like life insurance to annuity contracts. We do more of the safe money management idea behind it. We do also in the firm have a couple of security licensed agents that we do the managed brokerage accounts, rollover of IRAs and 401ks. What I want to talk to you guys about today, a little brief history of myself. I've been in the business since 2004, and my parents were insurance agents at Farmers Insurance for years, and then they started their own independent firm. So when I turned 18, I was going to school full time and decided that insurance, I'd like to look at doing it part time. In the meantime, while I was finishing school, I ended up getting into the business and just been a student of the business over the years, and have agents that work with me. My wife, Gina, I am married. Her position in the business is doing all the hard work, all the technical stuff back at the office. So I get to meet everybody, talk to them every day, and enjoy life, and listen to the opportunities that are out there and help people solve the opportunities that we're currently in. She gets to help me on the backside. So of course, doing all the paperwork. I have a little boy. He's 5 years old. His name's Peyton. So of course, keeps us busy with running around doing everything. I wanted to discuss some things with you guys today. Of course, insurance and financial services, the different ways you can position yourself, opportunities to take advantage of the system itself, and to know little loopholes that are out there, whether it's taxes or it's be financial putting money away and then accessing the money tax-free in the future, tax deferred, and then pulling it out without any penalties or any kind of issues from little Uncle Sam or big Uncle Sam, like we say. Something that we wanted to discuss, I did a little presentation, so it's pretty brief. Most of you guys probably been around and know what this is, which I'll share my screen. Let me know that you can see this also once I pull it up. Can you see this okay?
Not yet.
Not yet, okay.
No.
Let's see what I did.
Did you hit the share screen again?
I did, let me see. Let's try this now.
Nope. Not yet.
Nothing. Okay. Oh, we were just on it.
I know.
Let's see.
Try one more time. I just hit another button to see if that works.
Did you? Maybe it's on my end.
Cindy, you have him set up as a co-host?
Where do I set him as a co-host?
If you hover over his image, you should be able to come up with 3 little dots.
Oh, yeah. Okay, got it. Make co-host. Okay.
Now,
Yeah,
it should be- there you go.
now you should be able to share your screen.
For some reason, I lost the main part of the Zoom, but you can still hear me.
I can
Yes.
still hear you. We just can't see anything.
All right, let's try this again. What did I do?
There you go.
What about now? Can you see this?
Yeah, we see click to add title.
Yeah, that's not it. Let's see.
You're sharing the screen, but the wrong thing.
The wrong one. Yeah, let's get the right one up here. All right. I messed up something. So what I'd like for everyone to see is not coming up on my end to be able to share it. Can you see this? Is it red?
No, nothing.
All right. As you
You
can
can
see,
send it to me real quick and I can put it up on my screen.
bear with me for 1 second while
Try one more thing.
I'm looking for it.
Cindy,
He
you can also,
just,
Where did it go?
he just had it up.
Let's try it another way. Okay. Sure. All right, well, this isn't working like I anticipated it was going to. That's okay. What we'll do is I'll go through this with you guys. The main part of this, of what we do and being in the business, protecting your needs, there's different types of insurance policies out there. As you guys all know, there's insurance that you buy either for a term period of time. You have 10, 15, 20, 30 years that you guys are able to look at qualifying for. Term insurance more of covers you in the life insurance aspect, as you guys have probably all heard of before. It's very inexpensive. Working for a brokerage firm that we do at the Alliance Group, we're able to have these plans that are different than others, that they have built-in living benefits automatically. So there's 3 riders, terminal, chronic, and critical, that in the event that someone ever became sick or ill, you're able to access the benefits for certain reasons. The first one being a terminal illness. That's if someone was diagnosed by a doctor to have 2 years or less. You can take up to 90% of the value of the policy. And then there's also a chronic illness that if you're unable to do your activities of daily living, you can also access the benefits of the policy. If you're 2 out of 6 ADLs would be like bathing, dressing, continence, eating, toileting, or transferring. We think of it as somebody that's older or someone who got in a bad car accident. This kind of policy would allow you to access the benefits of it as well. So it allows you to unlock the life insurance that you currently have. The last ones are critical, and that's if you suffered like a heart attack or a stroke or had cancer. You also can access the benefits of the policy. So while you're living, more than anything in this world today, it's nice to be able to access benefits that are there for you when you do need them. The other part of it, and we think of it, term insurance, we like to call it stacking policies. So you would do a term and then preparing for the future. If you're raising a family, you'd get it for 20 or 30 years. And then at the end of that term or during the life of it, it can always be converted to something called universal. When I like to do insurance planning is very similar to Cindy, what I did for yourself, is to be able to add a policy additional to it, whether it's a universal life or an index universal life. These build up cash accumulation, and they are designed to be permanent, meaning that they go for you for the rest of your life. So they won't go up as term does in the future. The index universal gives you opportunities to be able to build up a cash based on an index fund. So you have your fixed universals, anywhere pays from 2% guarantee all the way to 5.25%, with interest rates on the rise, as we all see our famous Jerome Powell talk, and interest rates go up. This kind of account is structured that way, that it follows the interest rates at the yield of what the current interest rates are. So a fixed interest rate will follow it. Where an index universal, it follows an index fund, whether it's index fund is something like the S&P 500, the Dow Jones, the NASDAQ. You can buy different indices within this universal. These always have guaranteed minimums. So no matter what the account value is in it, you can't lose money. The guarantee is always 2%. But within these plans, you have access to it. So I know this is Cindy, your group is more of a networking group that talks about opportunities that could come up. These accounts like an Index Universal can be structured so that you can send your kids through college for the younger folks on the channel today, or if you have a supplemental retirement fund that you can fund money into them, and then you can pull the money out back tax free. A lot of folks on the phone call with us say, it sounds like, would like to know what the opportunity would be is if you ended up putting money into it, how to get the money back out and invest it in something like real estate, especially in the next couple of years. Out in Arizona, which we're out here, it's gone nuts. It's gone absolutely crazy. So if there's no way the interest rates, as they rise up, as we all know, the fall of the market, it goes in cycles. I heard Shane saying in the beginning of the call that the weather goes in cycles. Arizona's weather goes in cycles. Also, these markets we're in right now go in cycles. So as the market falls, there's some opportunity out there that you have. So when the market falls, you have the opportunity, if you have a universal or whole life, you can take the cash out of it, be your own bank, invest the monies into a piece of real estate, make some nice profits on it, or hold it for continued revenue flow. So these universals allow you, or Index Universals allow you to put money into them, pull that money out, be your own bank instead of going out and getting a loan from the bank or using someone else's money to do it. And we work with several different of the carriers at the Alliance Group that do them. These are all medically challenged. So to qualify for these plans, you have to qualify medically. So you have to go through an exam, you have to go through a blood test. Some of them you don't, depending upon health of the client. There's up to $1 million at a few of our carriers, and some of them can be up to $3 million of insurance. So it gives you the opportunity to be able to get a plan and then fund it and then pull that money out tax-free and not pay a dime of taxes on it. Now, if something happens, big question I would always ask, what happens in the meantime in the event that something happened to someone? You have access to that money, your beneficiaries will upon your death. So they'll have the tax-free life insurance, plus they're going to have the cash accumulation that's built up, plus the interest that it made. So it's a way that you're able to structure yourself, your future, that you're able to protect yourself upon the unexpected, but you can also protect your family and your loved ones in the event that anything ever happened to you. You have access to that benefit while you're living, and then when you pass, it pays the death benefit tax-free. So not the most exciting stuff, but exciting when you get into it and you can fund them, which I will give my information, Cindy, to you and see if we can post my business card as well as all of my personal information so that people can, if they're interested, looking at different plans that they live in, whether it's myself or a colleague of mine that lives in a state where they are. Every state has a different law that you have to be a non-resident in those states. So we can work with anybody and everybody that's worth you guys. I'll just have to work with the state that they're in. So there's a couple ways. Also, I wanted to go through that. In life in general, we all think of life as you make what you want out of it. And if you think about it as a hard thing that you're going through or someone struggling with, there's always another person on the other side that there's an opportunity to allow everyone to tap into it, of course, that you have access to opportunities that they might lose a house, which I don't want to say that this is going to happen, but as you guys might know, and Cindy, we've had a couple conversations about it, is that people could be in foreclosure, and then you could come in and basically buy their house and then fix it, get it ready to sell, and then flip it and make a nice chunk of money off of it. So there's so many ways, life insurance policies to be able to borrow the money out of them and fund life and fund your retirement or fund a college education or take advantage of an opportunity like we have now in the next, I would say, year to 2 years is going to happen here. where there's going to be a lot of foreclosures that are going to come up, and people that probably shouldn't have bought a house, but they did, and they're upside down in the house, and they'll let it go. And then you can come in as the bank and buy it and use life insurance to be able to help you and your family and help your investment group do what you guys wanted to do.
Hey, Jason, quick
Yeah, go
question
ahead.
here. I'm gonna botch your name wrong. Is it Kanini? 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 Sorry.
Kanini.
Quick question.
It's okay.
Do you want to ask the question or you want me to?
Oh, it's fine. It doesn't matter.
Okay, she wants to know if you have like 30K, wanted to put it all into your whole life policy. How much does it make how much face values? How much does it make your face value go up?
So we always, there's two options. So when you buy a whole life or a universal life, you have a value that as you dumping money into them, there's always they're flexible premium driven policies. So there's always a minimum cost of what it is to do the insurance, to pay the minimal bucket cost. And then anything above that minimum is all going to go to your cash accumulation account. You got to think there's cost of insurance fees, and then there's also the fees to be able to manage the policies. And over time, you think of this as your fees are going to be decreasing. They're not going to be increasing. Whether you have a brokerage account, as you earn more money, your brokerage account is based on the lump sum that you have in there. So if they're charging you 1% or 2%, it's gonna be a higher amount as your net worth or your account grows. Where life insurance is the reverse. So you pay a lot up front, but then over the years you pay lesser. So you have a level option or an increasing option. A level option would mean that if you are funding this for just the life insurance aspect and not the cash accumulation and the death benefit, you would do a level death benefit. Now, if you have a dump in of the monies, which I did 2 illustrations I wanted to show you guys today, but for whatever reason, it's not allowing me to share what I want. So the first one is to fund a college education for a child. And the second one is how to fund it properly so that you can retire off of these accounts and pull it out for opportunities like you guys are mentioning to buy real estate. But remember, you can't just put the money. It's not the best plan to put the money into it and next year pull that money back out. And the reason that is because there are, and I can sit down with individuals and explain this, but there's always a surrender charge that's imposed in these. And it's for 10 years that declines every single year you have it. So if it's a lump sum you're putting in, and then you're trying to pull that back out the next year, there's a surrender charge that's imposed. But I'll go through that with you guys. If it's someone that's interested in it, I'll put my information on this through Cindy, and we're able to get in contact with each other. So this is the amount that it increases is always based on how old you are. So is it Kanini? Am I saying that right? Kanini?
Kaini.
Kanini is that the way that the universals work is it's based on your age when you lock it in. So the insurance is based on your age as well as your health. It's locked in to stay the same cost. But then over here, the amount that you dump in, there's limits on how much. So anything that's good in the world today, the IRS has their hands in it. So they won't allow you to be able to put too much into these accounts before they say, hold on and say, where are you putting this? And then of course the insurance company will send the money back to you because it becomes, they call it a MEC, a modified endowment contract. But yes, you can do a lump sum dumping into them. And we would have to structure it based on the client's age, the health risk, and then how much you can put into it each year. I did a 40-year-old male, and I ran an illustration that just would give us an idea of how this works, and then how it can be funded and how it can be pulled from in the future. And I'm going to make one last attempt to try to share this and see if this will come up. If it won't, it won't. But
Yeah, fingers crossed for you.
let's try it. But this is something that, did this one come up?
Hey, I think
Am
we
I
got
in?
it.
Winner,
Okay,
winner, chicken dinner.
awesome. There we go. I'm just hitting the wrong buttons. It's on my end. So this is a company, American National. They're out of Galveston, Texas. Great company, A-rated. I did this. This is actually my son, which I did it when he turned, when he was 0. He was born in January. So he was born January 5 years ago, but I made this out that it looks like it's started right away, right now. So it was January issue. He's 0 years old. So it's $250,000 of face value. And this, it gives the death protection, of course, of a life insurance for $250,000. Now this would be on a child. And then of course, this allows him to increase this also different periods in his life without having to prove his insurability. So he doesn't have to requalify health-wise. This also is non-med to get there. We don't take blood tests from a 0-year-old. So this doesn't require a blood test or urine or nothing like that. It has living benefits. So the 3 I mentioned earlier, which is the terminal, chronic, and critical, which we'll go through in a few seconds. I'll show you the breakdown of it. And then the cash accumulation is what we're mostly interested. There, it's indexed, it's linked into an index fund. As you can see here, the S&P, which if you don't know, it's a Standard & Poor's 500. It stands for the 500 largest companies here in the nation. Then there's also the NASDAQ 100. These are the tech savvy companies. There's also the marked S&P 500. This has a risk tolerance on it, which has a guaranteed return of 5%, but it follows also the S&P 500. The other part is the income, which is what we want it for, to put the money out, put it away tax-free, and then put it in it taxable, and then pull it out tax-free. So you put the money in, you've already paid taxes on it. It accumulates interest, it builds up, and then you pull it out, whether it's a college education fund or it's retirement, tax-free money. So pretty neat. I'll show you this. This is just a quick little illustration I did earlier, but it talks a little bit about the company, A-rated company, what they have in assets, what they have in liabilities, and then of course, what they have in the surplus, which is the difference. They've done very good. They're one of the top 50 companies here in the nation. This is just one of them. I do work with around 22 different companies that does just these types. Now, don't get me wrong. Some folks too can start with term insurance. If they're young and they have a family and they're just starting out and they want to start with term, and eventually they want, we call it a conversion, right? You can convert a term life insurance to this without having to qualify for it. So that's always something that someone can do down the road if they're looking at getting it. So within this is the living benefits, the terminal, like we were talking about earlier, you can take a lump sum from if you were diagnosed by a doctor 2 years or less, up to 90% of the value. The critical, we see be in the business for 20 years next year. This is the 19th year, is I see more claims happen from this rider than I see other things. And these are life events that we never want to think of happening, but it's life happens. Things do come up, unfortunately, and you just want to be protected for it. So that's the critical illness. It breaks it down into multiple triggers that you can take a lump sum depending on the severity of the condition. The chronic illness is also, that's the long-term care. I was in a meeting earlier at 2 today, and one of my existing clients has a term, and she did a IUL for her son and then for her granddaughter. And she came in today. She wanted a meeting to talk about the insurances that she had. And she told me that her life has changed dramatically because her mom has Parkinson's. Her dad died last year, and her mom's living with her, and she has to take care of it. She's working full time. She's taking care of a 3-year-old grandchild, and she has her mom in her house that's Parkinson's. So her mom has not that much money, and they're paying, hospice is coming in the morning and in the evening to take care of her, where if they would have prepared right when we first talked about all of this, and the mom would have got a policy, the grandmother, she could have collected a benefit from her life insurance to pay for that long-term care. So if you look at it, the least, it's 2 out of the 6 ADLs: bathing, dressing, continence, eating, toileting, or transferring. The nice part with her policy she has is she's drawn income from the cash value to pay for her mom's care. So if she had this policy, her mom, grandmother, she could have taken from this because of the state that she's in today. And no one ever would have thought this would have ever happened, but it's life, things can happen. So they break this down, and you look at these numbers, they're ridiculous. 1.3 million at 55, 65, 75, they're huge amounts of monies that you can access. And this is because when you start this for a child, they're 0 years old, and you put some quite a bit of money for college education into it, it'll be there for the future. So this is the highest. I did this at the maximum contributions. So when I want to show you this always has a guaranteed interest rate, which is here. This is guaranteed at 2% interest. And then as we continue going through this, we're going to get to a column called the non-guarantee or the current projected illustration. Now, if you guys see over here, can you see with my scroller? Is my icon working or no?
Yeah, it's working.
Okay. So this is projecting a return of what the S&P historically has returned over 20 years, which is a projection. This is not going to be what the exact illustration is going to be on yours if you have started this one for your child. But 6.52% is an average return of what it's done over the past 20 years. They also have a non-guarantee of a fixed interest rate, which just means that they'll guarantee fixed rate of 3.5%. But if we look at this, so what I did was if we think of college education and funding for one of your children, and we think of putting money away, what does it cost for an average college education this year? $25,000 to $30,000 a year. If you're in state, if you're out of state, forget about it. It's expensive.
Forget it.
It's about 55 grand a year. So it's very expensive. Now, this does not have to be used for educational purposes. Whereas a 529T, which of course is for retirements or for college education. When I say retirements, they just passed a law. It's a Secure Act this year. It passed with the administration that's in, that allows you to put pre or after tax dollars into an account. And if they don't use the child for education, it can be used as a Roth IRA. So another advantage of doing a college education for your child, it can be used it that way, or fund a life insurance with it. I did this at an amount, $426 per month, $5,000 per year. This is the maximum that you can put into this. So what I did was I did this for the child for 18 years, as you can see on the left-hand side. And then the 18th year of it, or 19th year in this case, they're going to draw $25,000 a year out. So this $25,000 that represents the cash value, this is a distribution to you that's tax-free. $25,000. I did this for 4 years.
Jay said, I have a question for you. I know we're
Yeah,
supposed to
go
be
ahead.
talking about real estate, but now I do have a question about the
Oh, okay,
529. Because I'm dumping a lot of money into both my boys in a 529, right?
Right.
Which is better to make? I mean, I know you're doing insurance, but which is better to make the money? I mean, where should I be dumping it?
So a 529T plan is, if you look at it and what it's invested into, it's invested normally into the stock market. And I don't want to get on a soapbox on it right now, because we all have investment accounts. The market's getting killed every time they talk. And I'm sorry, guys, I don't want to get on it. There was more money lost in oil yesterday than in banks, than the financial system, than most. There was over $4 trillion lost yesterday because of the oil, what happened yesterday with the banks,
Yeah.
falling out. So, and it's a domino effect. And I don't want to get on a tangent about that. It'd be another conversation, but
Yeah.
it's a domino effect. There are going to be more banks that are going to fall with this, as we all have seen, and you're going to see in the news in the next couple of months. But 529T plan are invested directly into the market. So, which you're going to see ups and you're going to see downs of it. But for those years that you put into it, and it's a lump sum that's sitting there, your child's not going to go to school for 18 years in this case, 19 years that when they turn that age. So your money will make that money back. If they don't use the money for education, they just passed a law, the Secure Act, that allows them to move it to a Roth IRA. So it's a great concept. My idea is a life insurance plan. And don't get me wrong, I have a 529T plan too, just in case that he doesn't go through college. There's two amounts. He can buy an education with it. If college costs more, there's more money. I like to do both things in case one fails. You don't want all your eggs in one basket. So this is neat because it allows your child, in the years that they want to go to school, pull the money out tax-free. Now, educational on 529T plans, they have to be used for educational purposes, If they're not, then they're a taxable event. So and it has to be for that child. Can it be transferred to another child if something were to happen? No, this pays out a life insurance benefit that's tax-free, 25,000 per year. You don't pay anything in taxes. And as years go on in the future, we stopped it in the 5th year or the 23rd year. You continue, and this child continue, in this case, he's an adult, continues funding it. You hand it over to them, and they fund this until you reach the age of, and I put in at 67 because that's full retirement age. But
Yeah.
you can look at 60. There's $2.7 million in this account that they
Mhm.
can pull that money out tax-free.
So can I, I'm wondering if I should just take my money out of the 529 and dump it into my kids' IRA
Life
account.
insurance. So and you can, you have that option of doing it. Is it best to do it? I like to always, I'm in the position I can't get insurance. I'm in the business myself, but that's why I
Yeah.
got into it. It's because I have a story that you don't want to hear tonight, but
Yeah,
being positive is that you buy insurance when you can qualify, when you're young and you're healthy today, because we're never younger than we are today and healthier than we are
Well,
today.
we could have another conversation, side note, with my kids.
Oh, for sure.
I don't want to veer off the topic. I just,
That's good.
Yeah.
Good question though. Is it a good idea to do either one? This cannot lose money. You can't lose
Okay.
money in this. So by putting money into it and pulling the money back out of it tax-free, that's the way that you would like, you and I both, and everyone on this call, hopefully, wants to
Yeah.
be able to put the money away in the future. Now,
Okay.
let's say that they want to take advantage of an opportunity at 25 and go to trade school, or you wanted to buy your first house. There's $254,000 in the account that's there to pull from for whatever reasons. It's yours. You don't have to have it just for educational purposes. But it
Okay.
helps them prepare their future and in protecting their loved ones in the event that anything ever happened health-wise, it allows them to access it as well. So in a lot of, yeah, go
Actual withdrawal of funds from that account, correct?
say that again?
It's an actual withdrawal of funds from the account.
It is.
It's not a loan against the account, or funds aren't being provided that you have to pay back into the account. It's just accumulated monies that are yours.
That's correct. Well, there's two ways though, Shane, that you can take it. You could take it in a withdrawal against it. If you take it in a withdrawal against it, it's just a net withdrawal from your cash accumulation. Or if you take it in a loan against it, you're your own bank. So you would charge yourself either a fixed rate or a variable rate loan. And what happens at the end, if you do that, is if you were to pass away or cancel the contract, then the money would be given, the cash accumulation out back to you. If it's in a loan against it, the loan gets repaid before the cash gets distributed. But if it's a 4% loan and you're making 6.5% on the account, you're making money on the loan itself. That's the best way of taking the money back out of it in the future, is a loan against it. Does that make sense or no?
No, perfect sense. And to me, that makes more sense than just taking the money out and not feeding it back into the whole process, as if you replace it with a loan and pay it back. And that way the funds are always there and available again in the future, tax-free.
That's right. That is exactly right. Now, I did continue the illustration all the way down. Once you get to your age of 67, I had the account completely stopped funding. And then at 68, I pulled 100 grand a year out for 20 years. So what will 100 grand be in 68 at 68 years from now? Probably what it is at 50 grand or maybe less. So we don't know, but this is just a number I put in there, just hypothetical of what you can retire with and what you can pull from. Now, when you look at these numbers, and remember, this is 68 years for the account to compound interest daily. The net death benefit over in this column here, it's over $5 million. But again, you're starting this at a child right when they're born. So realistically, if you're someone's 35 or 40 or 50 or even 60, it's going to be different as, of course, the client's older. we have to structure it in their case so that it makes sense for them. And putting money into this after-tax dollars, this type of account allows you to build a cash value up and then borrow it back out of it. You're your own bank and take it back tax-free and have the death benefit as well as those living benefits. So different type of insurance that's out there. A lot of people don't understand this. And as soon as you start throwing numbers at them and borrowing in withdrawals and loans, they get nervous and it's too complicated. They don't think that it's too good to be true. Well, it's not. This has been in force. 1988, Ronald Reagan was president. He passed a law that allowed the rich to hide money. And this is where they're hiding it. Besides that in gold and silver and platinum and real estate right now, this is where they're hiding the monies at. So it's another little loophole in the United States tax code that allows you to fund a policy or put money into and pull it out tax-free.
So Jason, question for you. That example that earlier, the lady has $30,000 and wants to fund a life insurance policy.
Mhm.
Is there a limit as to how much you can deposit into the account per year?
There is.
Okay, what is that number?
So it's the MEC. It's a modified endowment contract is the legal term, 7702. It's a tax code that is based on how much insurance that's on the insured, and it's based on their life expectancy. So the way that we calculate it, if someone just says, I got 30 grand, I want to dump into it, it's not that easy. Sometimes we have to do it over 5 years or 7 years, or sometimes we can just dump the lump sum in every year. I'm going to show you another illustration. Every person's different, the way that they can qualify, if they're going to get preferred or standard or substandard, is that it makes sense in some cases. In some cases, it doesn't because the cost of the insurance is too much. But great question that she had. To answer it right would be is to have her scenario. And that's something that she can always reach out. I'm more than happy to run her illustrations and see what she's looking to do. But I can run for her what her scenario is and then show the values of how much she'll have in the future for it as well.
So if I had a child, let's see, that's not going to work, that example. If I had a new grandchild and I wanted to have an account that was going to be there for the life of that child, and I wanted to start funding, but can those funds be available to me to make investments with?
You can. You're the owner of it, so you have the rights, being either a parent or grandparent of the account, to withdraw the monies out at any time. So you could take out essentially a life insurance on a child or a grandchild and then use it for their or your behalf, however way you want to do it. If someone's not eligible for life insurance or it just costs too much, sometimes it's better to put it on the child or the grandchild and then have it funded, because the cost of insurance is it's very low. And then you pull that money out back tax-free.
So then you could basically create little banks for each of your beneficiaries, and use that money for investing purposes and grow those accounts tax-free. And then hopefully someday we have quite the legacy to pass on to each of our grandchildren.
That's
that-
awesome. That's exactly right, Shane.
One of our, Jason, you can clarify this for me, because one of our friends, Shane, that we have is Daniel Chun. And what he does is he takes out money against his policy and is a PML. And then once he gets his money back, he throws it back into his insurance policy. He puts it back.
So,
There's
yeah,
another one of my wealthier clients. He's an attorney here in town. He does very similar process. He likes hot rods and sports cars. And if his wife knew he was buying what he bought, she might get a little upset with him. So he puts money into a life insurance. He overfunds a life insurance and then he pulls the money out buys his what he wants, and he calls it his cash cow. So when he needs something, instead of going to the bank and getting a loan against it and paying interest to the bank, he takes the money from his insurance policy to be able to do what he wants with it. And then it gets old after a year or two, and he sells it and puts it back into the life insurance. And when he needs it, then he pulls it back out. So, and then he's using it as his own bank.
So just to clarify in my own mind, I'm gonna go out and buy me a hot rod using money out of my retirement account, my life insurance account. The car is in my name. The loan is in the name of, the bank, so to speak, is the life insurance programs. But I have control of the vehicle, make decisions. Does that make sense?
That's correct. Yeah, it is.
Yeah, okay.
It allows you to, and not the money sitting in the bank otherwise. Interest rates are higher. The high yield interest I found from 4%, all the way to 5.25% on a high yield interest account. And I can share with anyone that would like to know where that is at a bank. But I don't know about you. After I've seen what the banks are doing recently, I don't know if I want my money there.
Yeah,
Whereas
Jason, we've talked in the past about using a self-directed IRA to buy
Yeah.
real. But the trouble comes into, it's actually the self-directed IRA that owns that property.
Yes.
You're not taking a loan out from your self-directed IRA and using it, because that makes you a beneficiary, and that becomes
taxable event.
taxable event. Yeah, that actually, you cannot benefit from your investments from your self-directed IRA. It's forbidden. So you have to have arm's length transactions. So you couldn't go out and buy a rental house and a college town for your kid, for example, because they're direct descendant. But it sounds like in this instance, and again, not being an advisor here, tax advisor, or but it sounds like I could take the loan out from my life insurance program and go buy a rental house at the university and have my kid go to school there and live in that apartment. And then
sure
for
can.
school, sell that house and pay it back to my life insurance program. Is that
That's
right?
correct. That is correct. Now, I would advise you to, on tax purposes, advise you to get with your tax CPA and talk to them about that,
Yeah,
about
absolutely.
the tax consequences. But it's after tax dollars. So when you pull the money out, I would make sure, as you guys all know this, to make sure you protect yourself on the behalf of the LLC and a C Corp is doing separate LLCs for different transactions, for sure.
Absolutely. Yeah.
And then you never are the one that owns it, even though you are the insurer, which is in this case American National, but the owner of the property, you would make, of course, as the LLC that you would establish for that real estate transaction. And then it would protect you because you wouldn't be the one owning the property, your LLC does. But you guys probably already have someone that spoke about this. If not, I have a gentleman after tax season the next week. He would love to get on a conversation with you guys. He does big transactions for us and helps us do buy-sell agreements if we need to write up a business transaction, key man insurance policies. We have someone here locally that does that too. But in the state that you're in or the county, we can look and see if we have somebody in those areas. So I did also, not to jump too much, I know I talk a lot, and sorry, Cindy, I
Okay.
apologize.
No, it's okay.
talk
Go
a
ahead.
lot.
Do your thing.
The last part, are you able to see this one? It says
Yep.
John Doe.
Yep.
So this is one that I did on someone, and I just did this on a 40-year-old that would put money into this. Of course, based on every situation, it's going to be different. I did it based on a standard non-nicotine rate, actually. And there's two of them. So I did one standard and I did one preferred. And I wanted to see on this one, I max funded it per year. So very similar to the lady's question earlier that asked it, what if I did a lump sum into it?
Yeah.
This is similar to a question, how much cash, how much death benefit would I have? So this is based on her question, and a little hypothetical depending on her age, but situation of this being a standard, if you get a preferred, the figures just look better. But this person dumps in 27,000. They have a $500,000 life insurance right off of the bat. They dump in 27,000 per year. So this is max funded. So that's right under the MEC premium. And we fund this, say, for 20 years. When they turn 60, there's $1 million and 944,000 tax-free money. Tax-free, no taxable. If you never use your money, that 944 comes over here. And there's a $1.4 million tax-free to your death benefit to your beneficiaries. Unlike a 401k or a IRA, a traditional IRA, first, a Roth IRA, you can never dump this much money into it per year. A 401k with your contribution to your employer, you can, but then on the back end, you're going to pay taxes on it based on what your rate will be at the time of retirement. Where with this, you pay the taxes on the money going in, you pulling it out tax-free. Now, when you do a 401k, the max, and this is all changes every year, 19.5 is under 50, over 50, you have a catch-up rule. And I want to say, and don't quote me exactly on this, I want to say that it's 21.5. That's the most you can contribute to an IRA with a match of your employer. So where with this, you can catch up from those years that you didn't fund it. So if someone's just starting out and they've waited to save for retirement, this is a way that you can dump a bunch of money into an account. So if we think about this also at age 67, I didn't do it. There's another one in here that I did it based on how much money you draw from it. And I'll see if I can find it and share it with you guys, but it allows $144,000 a year per year for 20 years. It pays you that income back out of it. So this was just another one that I ran, and so I can build a plan for each individual person to satisfy what their needs are. If this is something that they're interested in looking at, it's in my wheelhouse. It's something that I do, that I believe in. I do have a SEP, which is a simplified employee pension or a self-employment pension that you can max fund, or a simple IRA. But that's on another. We could talk about something like that on another call or individually with anybody. But
You
this
have
is
me, you have me guessing maybe I should be dumping more money into my whole life policies.
and I don't want to tell you that this is the only way of doing it. The government cannot access your cash. Anything in this account here, they can't. They can take from your 401. The 401k, you have a partnership, and none of us know what it is.
Yeah.
And the partnership is when the IRS decides that you retire and what the percentage is that you pay them in taxes. Whereas with this, it's more flexible, and you're the owner of your own account, that you decide on when you want to pull it out, how much you want to pull. If you want to retire at 50 years old, instead of drawing from your 401k that you're paying a penalty and the federal and the state income tax, you can draw from this to get you to your retirement if Social Security is still there, or a pension that's still there if you have one. So this is a neat way of putting money away to allow you to build it up and then protect yourself while you're living on the living benefits, and then also the death benefit.
So Jason,
Any
what are
questions? Yeah, go ahead.
some of the fees associated with having an account?
So these accounts up front, just like buying a stock or a mutual fund, they charge a fee once you buy it, a front load fee or a rear load fee when you sell it, or a management fee over the years. This is very similar. This is the insurance company are charging you a cost of the insurance, which is all rolled into this. Individually, it's going to be different for every person, but they give you a upfront cost of the insurance, and then it's going to be an administration cost, which is to administer it. And then there's a service charge that the companies charge you. And it's not a set fee per individual. It's built into the premiums. You're paying what you put in. The fees are built into the schedule. As years go on, the fees of these go down as well, depending on how it's structured. I did it at a level benefit. It's structured different than an increasing benefit. What the increasing benefit is doing, it's paying your cash value plus it's paying your death benefit. So in this case, you're paying for more insurance over time. But if you fund it correctly, is this policy should always be there until you passed away and for everything that you wanted to. If it's set up properly, if someone funds this at the bare minimum and they're hoping that they're going to be a millionaire at age 60 years old, it wasn't properly funded. You're not going to, it's not going to, the fees that were built in, or if they're doing a huge death benefit for life insurance, that's not the way these should be structured. You should buy term for that 20 or 30 years. If it's a 40-year-old and they have children, you buy the term for the 15 or 20 years until they're out on their own. And then you max fund these index universals with how much you per year can put into them. But that's something that I would sit down and structure it for you to see what the true value of what you need is. But to get back to your question, is the fees are involved in paying for the cost of the insurance. You're at admin cost, and then there's a service charge that they charge you once a year. And it's like the admin charge can range from 1% to 3%. It just depends on what the company wants to charge.
When we talk about, I got a couple questions. So
Yeah.
My first question is, we talked about a beneficiary. You can have traditional beneficiaries, children, grandchildren, et cetera, spouse, et cetera, but you can also put all that into a trust. Yes.
Yeah, that's something else that I would highly recommend for everybody that's on the call today. If you don't have one, make sure that there is a living trust that has built in a last will of testament. That's for your POA, your power of attorney over your financial means, and also over your financial, I'm sorry, and your healthcare. That will have your do not resuscitate, or if someone was in a position health-wise that's set up. Otherwise, when you go to the medical, you go to the doctor, the hospital, they're going to ask you that. Do you have a power of attorney? And if not, they usually can do it there. But inside of a living trust and the last will of testament, it will have the POA over both financial and it'll have it over medical as well.
And then when we talk about retirement planning, we have this as one option for growing tax-free money. But other tools we have in our tool belt are things like a Roth IRA. How do you use those things in conjunction with each other? This isn't a replacement to the other vehicle. Is that correct?
That's exactly right. It is not. I don't recommend. I'm a big guy. Cindy knows me pretty well, that I'm like 6'5", 320 pounds, pure muscle, but I'm not. I'm a big guy. So the reason I say that is when I sit down on a stool and, like a desk stool has 6 little legs off of it. Same thing with a regular stool, has 4 legs. I always want to make sure that it's stable. You never want to fall off of a chair, right? So in retirement, I want it the same way. So when I think of it in a 4-leg strategy, is that you have 4 ways of receiving an income. So the first way would be a 401 or a pension if you have it through your employer. That's max contributed from the employer. So if it's 6% or 8%, or it's up to 10%, you want to max it out of what they contribute. The difference in monies can go into a Roth IRA for everyone that can qualify. But a lot of you guys might make too much money to even qualify for a Roth. What the Roth means is, of course, money that's taxed going in, but tax-free coming out. When I say qualify, is that when you're at a higher income earner in life that you have of income, you can't fund a Roth IRA. So your other alternative, which should be anyway, is an IUL like this. So that's the wheelhouse of the third, the index universal. And then the fourth, which is hypothetical. And in your guys' case, you guys know what that is your real estate. Is the other fifth, I would imagine, is going to be Social Security, which some of you that are on it, that are older, are going to be receiving it. But for current beneficiaries that are getting it, the people that are working to provide it. Okay, so the that might not be there for the younger population. So I don't like to use that as a strategy, a part of the 4-leg process. The fourth leg would be a real estate investments that you guys are doing, whether it's meant to earn an income from and paid for, or if it's 1031ing the monies to another piece of real estate. That's your guys' deal. So I won't get into too much of that. But that's the 4-leg strategy. That's what I like to always prepare when we're insurance and financial planning with clients.
Jason, I feel like me and you should get together and talk about me.
Okay.
Because
that's it.
I'm wondering if I'm funding and putting too much money in my 401k through my employer. So we could talk about that. I mean, but I think we should talk next week.
Sounds
That's
great.
what I'm saying. Yeah.
That sounds great. Then there's so many ideas that I have ideas. If you think of planning, if we plan, there's a saying out there, and you guys probably have heard this a dozen times from multiple financial guys, or if it's
Yeah.
from general people. If you plan in life, you will make it. Or the plan is that you don't plan to fail, right? You fail. People that don't plan, no one wants to fail in life, and no one wants to fail for retirement. But if you don't sit down and discuss these opportunities and these times that we're in today, is we never want to think of anything happening to anybody, but we want to be able to protect it and have it there when the time comes. And for retirement purposes, these index universal life contracts are, and I don't want to, if they're funded correctly, are awesome to have as one of your legs in your retirement and your financial plan. It should be in everybody's.
Yeah. So back to the question, dumping 30K into a whole life policy, how much can we get back? I mean, how
Well, if
much can we use to invest in real estate?
So, and again, if you're buying it and letting it sit and hold there until the opportunity comes in a year or 2 years,
Yeah,
every scenario is going to be different. Does it
Okay.
make sense for everyone to do that? If you're buying it next month, no, it doesn't make sense.
okay,
If you're buying this in 2 years from now or 5 years from now, of course, it's a nice nest egg to allow it to sit, earn interest, and then pull that money back out tax-free in the
Okay.
future, or reinvest it and then dump it back in. You have that opportunity to be able to do it within.
okay. No, that's good. I mean, yeah, I mean, I already obviously have IUL policy, so I'm just wondering if I, dump it 30K in, and then the next, decide 2 years that, want to buy a house, a rental house for generational wealth, then that's a good idea. Kanini, do you want to ask your question? Or you want me to ask it again?
Yeah, go ahead. You can ask it.
She wants to know, if you transfer your life insurance policy to another company, does that decrease your face value amount because of the fees?
So it does. It depends. If the policy that you have is a very expensive whole life policy, and you surrendered it because you're within the first 2 years and you're like, I don't want this, and you dump a big chunk of money into it in the beginning and you replaced it, first, the agent that does it has to make sure that it's bettering the client. You can't just transfer it over or replace it and 1035 the money over into this new IUL. You have to make sure it's the right situation for each client. So if you are in an overpriced and someone set you up with a whole life that was very expensive and it made sense to you to take the cash value out of it and roll it over and put it into an IUL, then yes. But if you're older and you've set up this UL years ago and it's paying great interest on it, the cost of the insurance is higher as you get older, so it wouldn't make sense if it was already established. But that would always depend on the client situation. And I can look at a policy and compare it to what we have to be able to know if it's a win-win for the client, not for these insurance companies. Because ultimately I work for my clients. I'm not working for these insurance companies,
Yeah,
if that makes any sense.
Yes. Would I be able to do that with you?
You can. So it depends on the state that you're in. I can look at a non-residence if I don't already hold one in that state, and then I can review what insurance you have, and then I can run the different numbers and make sure that it makes sense. And then yes, I can look at it and see if it makes sense for you.
Okay. Yeah, I'm in Hawaii.
In Hawaii,
Yeah.
excellent. So that's something that I'll have to get a non-residence for, but I'm more than happy to look at what you have and see if we can help you. And then I would, yes, reach out to the Department of Insurance and get a non-residence and be able to help you in the event that I can.
Okay. All right. Thank you.
You're welcome.
Give us an idea of, you know,
Oh, the time's changed.
yes. So I apologize. We had just a bunch of people join in. You guys, this is recorded, so, but Jason's still here. And I could twist Jason's arm if he wants to stay a little longer.
And you can, I have another meeting that's at 5:30. So I have about 15 more minutes that we can discuss this in the subject, and also talk more individually if there's anybody that I can help. And of course, Cindy, you're always there at any time. I'll always help you with anything you want.
Yeah.
So
Does,
What is
Go
the
ahead.
best way to get a hold of you? The number that you put in the chat?
yes, I'll give you guys all my contact info.
yeah,
And so you
Okay.
have it, my email or my cell, my office number, and then my website. You guys can go on to everything.
yeah, I will put it, I put it already, his, phone number in there. I will do that again and put his email address in there for you all. Jason, actually, which address do you want me to use? Because I always use your Gina and
use-
Jason.
Use the Wade INS. So Wade
Okay, got it.
INS.
Got it. I have it.
Jason, give us a quick rundown on what the process looks like for someone like myself to get the money out of my life insurance to make an investment. What does that process look like? How difficult is it? How fast or slow is it?
So it's an easy process. So as the agent, whether it's in the state that you're in, your current agent, you can ask them, you can first reach out if you don't already have a statement, ask for what the current values are from your insurance company. And then from there, you're gonna want, if there's enough money in the cash to withdraw or take it in a loan, you're gonna ask them for a loan request or a withdrawal request. And then there's simply a piece of paper that you will sign, scan it over, fax it over to the company. And then if you put your banking information, they're going to EFT it right into your account. So I've seen it happen and expedited in 3 to 5 business days. Or if it's not expedited, it's usually 7 to 10 business days.
That's not too
Good.
bad.
No, very great question though.
Difficult, so that's good.
So I believe you're going to see something that
There
I
you go.
found. Can you see this, Cindy?
Yes, I
This is
can.
so it was my error and I apologize. This is the screen that I wanted to all quickly for everyone that's on the call. I'll do this again very quickly, just because I didn't get to do it earlier in the presentation. But mainly myself, been in the business for years. We do different types of insurance planning and retirement solutions. So my wife works with me. She does a lot of the admin part of it. But of course, what we can help with, we are licensed to be able to look over insurance plans, look over financial plans, and be able to know what you have and put it away. Now, this isn't today, but I also do something called a fixed index or a fixed annuity, or just assets. They call it assets under management. We have a gentleman in our office, and then of course I'm licensed to be able to do it as well. But with this case on an annuity is the fixed interest on annuities, which you can do like a multi-year guarantee, that are paying great interest on it right now because interest rates are on the rise. Tax retirement, which of course is talking about an index universal life. a way that the IRS allows you to put money into an account to have it after tax dollars be funded and then pull it out tax-free for retirement, to supplement the retirement, not just only for retirement. And then, of course, all of our products, whether it's a term insurance or it be a universal or whole life, are from the top rated companies here in the nation. So I'm an independent agent. I can work with any of the top rated companies here in the nation. As we talked about earlier, there's those three options. There's term, universal life, and then an index universal life, which they all have and they serve a purpose for different reasons. So everyone, I like to stack them like we mentioned earlier, which is doing a combination of both term and index universal. And then, of course, you can buy a term in the amount of years, 10, 15, 20, or 30 years. And the lower the term years you look at, the cheaper that it is. The conversion rate on these allow you to be able to convert them to a permanent plan if you're younger and have a family and just need to be covered. And then you can get into the cash value funding part of it. And then, of course, the universal type of plan, you can have coverages that can go from to age 100 to 120, can provide you with the living benefits like we discussed, and also have different riders we can have added to it. It also, as you guys know, it's tax deferred interest, and then it's tax free when you pull it out. As long as it's in a loan form, if it's in a withdrawal form or you canceled or surrendered it, then it's a taxable event. So I can say it again. So it's tax deferred interest on your money, but then it's tax free when you pull it out in a loan form, as long as the insurance stays in force. If you withdraw it or do it in a surrendered form, you're gonna, and you don't 1035 the money over, it's a taxable event. And then, of course, the upside potential of interest rates is a index universal life gives you the opportunity of not just fixed interest, it gives you the potential of participating in the indexes with potential of earning more interest off of it. So I'll be very quick. I know I just did this earlier, so everyone that was with us earlier, it's kind of the same thing, but it goes through the living benefits that are built into every contract that I set up, that you can use them and you don't have to die. When we think of life insurance, most of us think of death insurance. It only pays when you die. You know, it's actually a vehicle that you, not a driving vehicle, it's a vehicle that you can use to do college education funding, or to be able to fund a supplemental retirement, or buying real estate with the cash value that's in it. Like we're about to hit a market that all you guys are going to jump into, I'm sure, is that people lose their house because they got into a bad situation, and you have the opportunity to be able to buy the house on pennies on the dollar and make some money off of it. So that gives you the bank money to be able to do the opportunity that comes up. The chronic and critical, if you ever get sick, the worst thing is to borrow money from anybody, but to take the money out of your life insurance, it allows you, if you ever get sick or need the money from it during different triggers, will allow you to take the death benefit in advance. When is the best time to buy it? We always think of, when is it today? Because you're never younger and healthier than you are now. Saving today will protect for you tomorrow's. So the last part that I did is, here's all my contact info. So I don't know if you can do like a screenshot, or if people go back to this, this is my email, my office number, my cell phone. And then I also have a website that is the bottom right-hand corner that you can go to, and you can contact me that way also if you didn't want to call me or email me. I do accept text messages as well. So on the cell phone, not on the office, because that's actually an old school landline. But anyway, just to have that up, everyone has my contact info. Do you guys have any questions over anything?
Jason, can you make that available to Cindy? Maybe email it to her. That way
Yeah,
we can share that then with the rest of the group, and people that came later maybe will join and watch it afterwards.
excellent. Yes, sir. And thank you guys both. I want to thank you, Shane, and thank you, Cindy, for having me on today. Sorry that I took a little more time than was expected. But if anyone has any questions or concerns or things for their own personal sake, I'm more than happy. I'm available. I am in Arizona, so it's daylight saving times. I want to say it's just 2 hours ahead for the East Coast. But any questions that you guys might have, and if there's any way that I can help you or help your family, that's what we're here for. And thank you guys again so much for sharing
Yeah.
this.
Yeah, thank you. Thank you so much, Jason. We'll talk next week about
Okay,
me.
that sounds great. And thank
It-
you, Shane. I appreciate it.
Yeah, we might take up on the opportunity and talk about the LLC on a different show. So
Yes, sir. We can talk about it. He's a great CPA here in Arizona that can share his knowledge and his information with everybody. But we can do that because the whole tax is next month. He's slammed busy till after. But we can talk about
Yeah.
that as well.
yeah, I think we're booked through all of April anyway, so it wouldn't be till May or June.
Yep. Well, thank you guys again. You guys, everybody on the call. I hope you guys have a wonderful day and a good night tonight.
Thank you.
Thank you.
Bye-bye.
Thank you.
All right.
Appreciate it.
Thank you so much.
Bye.
Bye, guys.